This is the most asked question by Dutch beginners. VWCE or IWDA. If you are new to investing in the Netherlands, you have probably asked this yourself. You see these two ticker symbols everywhere on forums and in guides. They seem to be the default starting point for anyone looking to build a simple, effective portfolio. The good news is that you are asking the right question. The choice between these two exchange-traded funds, ETFs, is a great place to start your journey. It shows you are thinking about diversification and costs, which are two of the most important factors for long-term success in the market. Answering this question can feel overwhelming at first. There is a lot of information out there, and some of it can be quite technical. Many new investors want a simple answer, a clear path to follow. We will break down both VWCE and IWDA in simple, easy-to-understand language. So, what is VWCE? Let's decode the acronym. The full name is Vanguard is the company that manages the fund, one of the largest and most respected in the world. FTSE All World is the name of the index this fund follows. An index is just a list of stocks. This one aims to include almost every public company in the world. UCITS is a regulatory stamp of approval in Europe, ensuring certain investor protections. ETF stands for Exchange Traded Fund. It's a basket of stocks you can buy and sell on an exchange, like a single share. The key to understanding VWCE is the all-world part. This fund gives you exposure to the global stock market in a single purchase. It holds thousands of stocks from dozens of countries: United States, Japan, Germany, China, Taiwan, Brazil. By buying one share of VWCE, you are instantly diversifying across large companies, medium companies, smaller companies, all over the planet, not putting all your eggs in one basket. Another crucial part is accumulating. Dividends are payouts when companies distribute profits to shareholders. The fund doesn't pass that cash on to you directly. Instead, it automatically reinvests those dividends back into the fund. It uses that money to buy more shares of the companies it holds. Now let's turn our attention to IWDA. The full name is iShares Core MSCI World UCITS ETF. iShares, the ETF brand managed by BlackRock. Core, a foundational building block for portfolios. MSCI World, the index IWDA tracks. Different from the index VWCE follows. UCITS, regulated for European investors. The commonly discussed version is distributing. Accumulating versions also exist under other tickers. The key difference, MSCI World focuses only on developed markets. Unlike the All-World Index, it holds large companies and mid-sized companies from about 23 developed countries: United States, Japan, the United Kingdom, other European nations. It does not include emerging markets like China, India, Brazil. It's a bet on established economies, historically main drivers of returns. Many beginners first meet the distributing version. Distributing funds handle dividends differently than accumulating funds. Companies pay dividends, the fund collects them, then pays them out to you, usually quarterly or semi-annual. The cash lands in your brokerage account. You can withdraw and spend it, or use it to buy more IWDA shares. IWDA is highly diversified but limited to the developed world. Robust and well-diversified, but not the entire world. When you are investing for the long term, every fraction of a percent matters. The fees you pay on your investments are a direct drag on your returns, and their impact compounds over time. This is why comparing the costs of VWCE and IWDA is so important. The main fee to look at is the total expense ratio, or TER. This is an annual fee that the fund manager charges for managing the fund. Administrative, legal, other operational costs. It is automatically deducted from the fund's assets. You don't see it leave your account, but it does reduce the fund's performance. Let's look at the numbers as of today, May 17, 2026. The Vanguard FTSE All World UCITS ETF VWCE, has a total expense ratio of 0.22% per year. This means that for every 10,000 euros you have invested in VWCE, you will pay 22 euros in fees over a year. Now let's examine IWDA. Its total expense ratio is 0.20% per year. For every 10,000 euros, your annual fee would be 20 euros. So IWDA is cheaper by 0.02%. This is a very small difference, only 2 euros per year. Both ETFs are exceptionally low cost. You are not making a mistake based on fees alone. Diversification is often called the only free lunch in investing. It is the practice of spreading your investments around to reduce risk. If you own shares in thousands of companies across the globe, the poor performance of a few is unlikely to sink your entire portfolio. Both VWCE and IWDA are highly diversified funds, but they do it in slightly different ways. This difference in their investment universe is arguably the most important distinction and can have a real impact on your long-term returns and risk exposure. VWCE, by tracking the VWCE All-World Index, offers the broadest level of diversification. As of our 2026 check, it holds over 3,700 stocks in more than 40 countries. The key feature is its inclusion of developed markets and emerging markets. Approximately 90% is invested in developed markets like USA, Japan, Europe, while the remaining 10% is allocated to emerging markets such as China, India, Taiwan, Brazil. This means when you buy VWCE, you are getting a piece of the entire investable global stock market, weighted by market capitalization. IWDA, on the other hand, tracks the MSCI World Index. This index consists of around 2,500 stocks from 23 developed countries. As you can see, it holds fewer stocks than VWCE. More importantly, it has zero allocation to emerging markets. It is 100% focused on the established economies of the world. While still massively diversified, it is a less complete picture of the global economy. The question then becomes, do you want emerging markets in your portfolio? The way a fund handles dividends can have a significant impact on the simplicity of your investing strategy and, in some cases, your overall returns. As we have touched on, VWCE typically represents an accumulating approach. IWDA typically represents a distributing approach. Understanding this difference is crucial for a beginner. It determines whether you will receive cash payments from your investment or if the growth will happen entirely within the fund. It's a choice between a hands-off approach and a more interactive one. VWCE is an accumulating fund. Dividends paid by the companies are automatically and internally reinvested. You never see the cash. It does not land in your brokerage account. Instead, the fund buys more assets, lifting NAV and price per share. This is the essence of compounding in its most seamless form. The most common IWDA version distributes cash to you, typically quarterly or semi-annual. You can withdraw for income or manually reinvest. For most Dutch beginners, the accumulating model of VWCE is often the simpler and more efficient choice. It puts your portfolio on autopilot, ensuring every cent is put back to work and avoiding cash drag. It also simplifies your record keeping. For any investor in the Netherlands, taxes are an unavoidable and important consideration. The way your investments are taxed can have a significant effect on your net returns. The Dutch tax system has its own unique rules, particularly concerning investments held in Box 3. For most beginner investors, their portfolio of ETFs will fall into this category. The good news is that for the purposes of the main wealth tax in Box 3, the Dutch tax authorities, Belastingdienst, treat VWCE and IWDA very similarly. The tax is levied on the total value of your assets, not on the specific type of fund, or whether it distributes or accumulates dividends. However, there is a more subtle tax issue to consider: dividend leakage. This refers to foreign withholding taxes on dividends that cannot be fully reclaimed. For example, when a U.S. company pays a dividend, the U.S. government withholds a tax. Because both are Irish domiciled, they benefit from a treaty reducing withholding from 30% to 15%. Both funds are equally efficient here. Practically neither has a decisive advantage. Simplicity again favors accumulating for admin ease. Theory is great, but practical application is what matters. How easy is it to actually buy these ETFs? For most Dutch beginners, the brokerage platform of choice is DEGIRO, known for its low costs and user-friendly interface. The good news is that both VWCE and IWDA are extremely easy to find and purchase on DEGIRO. They are among the most popular ETFs on the platform, and you will have no trouble locating them. It is important to select the correct exchange. For a Dutch investor, choose Euronext Amsterdam in euros to avoid currency conversion fees. DEGIRO's core selection can allow one free trade per month per ETF under conditions. Double-check the current list. It can change. Search the ticker, ensure Amsterdam listing, enter shares, and place your order. From a pure usability standpoint on DEGIRO, it's a tie. We have walked through the details, comparing VWCE and IWDA, cost, diversification, dividend handling, Dutch tax implications, and the practicalities of buying on DEGIRO. Both are excellent low-cost, broadly diversified funds. You are unlikely to make a poor decision by choosing either one. However, the goal here is to provide a clear recommendation for the typical Dutch beginner investor in 2026, and for that, a winner does emerge. For the majority of people starting their journey, VWCE is the superior choice. The reasoning is based on the principle of maximum simplicity and completeness. With VWCE, you buy one single product and you own the world. The inclusion of emerging markets provides more thorough diversification, capturing the growth of all global economies, not just the established ones. While this adds a small amount of volatility, it also offers a more robust and future-proof portfolio. Furthermore, the accumulating structure of VWCE automates reinvestment, putting compounding on autopilot and reducing admin. The slightly higher expense ratio of 0.02% is a very small price to pay. Therefore, my clear recommendation is this. If you are a new investor in the Netherlands seeking a single, simple, and effective ETF to start your portfolio, choose VWCE.